Welcome back to Investing Talk Podcast. Today we're doing a focused exploration of United Airlines Holdings using the analysis and news you've shared. Our goal is really to distill the key insights, figure out what's most important right now. We've got info on their recent financials, overall health, competitive position, even some expert takes. So let's unpack this.
Sounds good. It's a solid set of information. Gives us a pretty clear picture to work with. Maybe start with those recent financial highlights. Q1 2025. That $13.2 billion revenue figure, it really jumps out.
It certainly does. And it wasn't just the top line, right? This was their strongest quarter in 5 years. Pre-tax earnings, $478 million. Diluted EPS at $1.60.
Okay.
What caught my eye was the growth across the board in passenger segments. Premium up 9.2%, business 7.4%, even basic economy up 7.6%. And those international yields look robust too. Atlantic RSM up 4.7%, Pacific RSM a big jump, 8.5%. It really seems like they're, firing on multiple cylinders at the moment.
Yeah.
What do you think is driving this?
Well, several things likely feeding into it. That broad revenue growth across cabins, it suggests pretty solid demand from, different types of travelers. And those strong international yields, especially Pacific, that could be smart route management, maybe just continued travel recovery in those regions.
Okay.
Plus, pulling in $3.7 billion in operating cash flow and over $2 billion free cash flow in one quarter. That points to pretty efficient operations, strong underlying profit.
Let's put this into context with the full year 2023 results then. Total revenue hit around $53.7 billion. That's nearly a 20% jump from 2022. And like you said, passenger revenue was the big engine there, up, 22.5%?
A huge driver.
But on the flip side, cargo revenues took a big hit, down about 31%, though third-party revenues grew 15%. That mileage plus credit card deal with JP Morgan Chase seems important there. How much should we worry about that cargo drop given the overall growth picture?
That's a really good question. I mean, the overall growth is impressive, no doubt, mostly from the core passenger business. But a 31% drop in cargo, that's not insignificant. It's something to keep an eye on. Could be broader market shifts in cargo or maybe challenges specific to United there.
Right.
But passenger revenue is just so much bigger for them, so the overall profit impact might be, softened a bit, especially with passenger and third party doing so well. Still, it does flag a potential weak spot if those cargo pressures continue.
Okay, switching gears to financial health. Things look pretty positive here, don't they?
Yeah.
They're sitting on over $18 billion in cash and liquidity. That's a hefty buffer.
A very significant buffer.
And they've chipped away at their net leverage, down to 2.0 times from 2.2 times at the end of 2024. Plus that huge free cash flow number in Q1 we mentioned. We're also seeing EPS growth and operating margins around 3–4%, so profitability seems to be improving. What does that lower leverage really signal about their risk?
Reducing leverage is definitely a good sign. It shows they're managing debt well, strengthening the balance sheet. Generally, lower leverage means less financial risk, right? Less debt relative to equity. It gives them more flexibility to handle, say, economic downturns or jump on growth opportunities. Paired with the strong liquidity and cash flow, it suggests a pretty solid financial footing underneath.
Let's talk strengths and maybe potential red flags. Strengths seem clear. Huge global network, those key hubs are vital. Strong financials, obviously. Strategic investments, too. Fleet modernization with the 787s and A321neos, plus digital transformation efforts.
Those are key pillars.
But then the red flags. That cargo decline we discussed, and also a planned cut in domestic capacity, about 4% starting Q3 2025. And they've got orders for, over 50 Boeing 787s and 60 A321neos still coming. How might that domestic capacity cut play out for travelers and revenue, especially with new planes arriving?
That domestic cut is an interesting strategic choice, particularly, as you say, while bringing in new, likely more efficient aircraft. Could be a reaction to a few things. Maybe they see demand softening in certain domestic markets. Or maybe it's a strategic shift, reallocating planes to more profitable routes, perhaps international ones where those new 787s fit best.
Focusing resources.
Could be. For domestic travelers in affected markets, it might mean fewer flight options, maybe higher fares if demand stays put with less supply. For United, it's a trade-off. Optimizing profitability on key routes versus potentially giving up some market share domestically. The new, potentially larger planes might offset some seat reduction on core routes, but the overall domestic network might shrink a bit.
And how do they stack up against the competition?
Yeah.
Delta Airlines, American Airlines Group are the main ones mentioned. The analysis suggests United's edge comes from its hub efficiency and that fleet renewal supporting premium international travel. It also highlights a big focus on innovation, digital tools, along with the fleet plans. How does that digital focus compare to Delta or American, do we know?
Well, in today's airline world, digital is huge. It's a key differentiator. Good tech can smooth out the whole customer experience, booking, check-in, in-flight communication. If United really is ahead in using tech for, say, a better app, more personalized service, or more efficient operations like baggage handling,
Right.
that can absolutely build loyalty and save costs. It directly impacts whether passengers choose them again, so it's a potentially powerful advantage if they're executing well there.
Looking ahead then, catalysts seem to be continued aircraft deliveries. Those new routes they launched in April, San Francisco to Adelaide, Guam to Taipei, and upcoming earnings reports, of course.
Always important.
But there are risks, too. Potential regulatory changes on emissions or fuel price volatility, that's always there, and just broader macroeconomic factors hitting travel demand. Those new routes, Adelaide and Taipei, what do they tell us strategically?
Launching those specific routes gives us some clues, I think. San Francisco-Adelaide suggests they're pushing further into Australia and the Pacific, targeting both leisure and business. And Guam-Taipei looks like strengthening their network within the Western Pacific, connecting key hubs there. These moves, especially the long haul to Adelaide, fit with their international strength and those new long-range planes they're getting. It signals they're actively looking for and jumping on new market opportunities.
And finally, market sentiment. Seems generally upbeat about how United is operating things. Analysts seem to like the balance. They're striking expansion, but also fiscal discipline, like share buybacks.
A balanced approach is often well received.
Social media sentiment, mostly positive, though some caution around fuel costs persists. Which brings us to the summary recommendation. Hold the buy. The rationale cites strong fundamentals, profit gains, strategic investments, but tempers it with the cargo weakness and capacity cuts. Financial health seen as robust, good liquidity, strong cash flow. Seems to view as it's a solid option for exposure to a major carrier with global reach. What's your sort of final take, pulling it all together?
I think the information paints a compelling snapshot of United right now. They've clearly shown strong performance, particularly passengers, and they're making those forward-looking investments. That hold to buy feels about right. It acknowledges the positives, the momentum, but also points out the areas needing monitoring cargo, those capacity tweaks. Their focus on international routes and modernizing the fleet seems like a key strategy in a really tough competitive market.
So wrapping up, looking at all this, you get a picture of a company with strong recent results and a pretty solid financial base. Passenger travel growth, especially premium and international, that looks like the main story. But those cargo challenges and the planned domestic capacity trimming are definitely points to watch.
Absolutely. Need to see how those play out.
Their strategy seems clear. Leveraging the hub system and fleet modernization for long-haul international. The comparison with rivals underlines that. The hold to buy suggests, cautious optimism. Keep an eye on demand trends and cost management going forward. We hope this discussion has helped clarify the key takeaways from the info you shared. Obviously, this is just the start. You could go deeper into the fleet details or the impact of those new routes. What other questions does this bring up for you? We definitely encourage you to subscribe, like the show, and please leave a comment with any follow-up thoughts you have.